ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ጥራት ባለው ስልጠና ልዩነት መፍጠር ዋናው ዓላማው ነው። ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅና ባገኘንባቸው በማስተርስ ፕሮግራም ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምቢኤ በባንኪንግና ፋይናንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድና ኢኮኖሚክስ፣ ኤምኤ በሆስፒታሊቲ ማኔጅመንት፣ ኤምኤ በሎጂስቲክስና ሰፕላይ ቼን ማኔጅመንት፣ ኤምኤስሲ በአቪዬሽን ማኔጅመንት ተማሪዎቻችን በልዩነት ይማራሉ። በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በመጡ ፕሮፌሰሮች ስልጠናው ይሰጣል። ናሽናል አቪዬሽን ኮሌጅ በዲግሪ ፕሮግራም በአቪዬሽን ማኔጅመንት፣ በአካውንቲንግና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት፣ በሆቴል ማኔጅመንት በምዝገባ ላይ ነን። በአጫጭር ኮርሶችም በፍላይት ኦፕሬሽን፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆስቴስ፣ በሆስፒታሊቲ ማኔጅመንት እናሰለጥናለን። አድራሻ ከ22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
Hello.
Hello, doctor.
How are
Good
you?
evening. Good evening. Good evening.
Good evening. How are you doing?
We are fine. We are fine.
Okay. Sorry for the delay. I've been trying to connect.
So,
In fact, I've sent you a message.
through my email.
Yes, through your email.
Okay.
But I thank God I've managed. I've just gone back to the old message.
Okay.
I received a message to tell me that I cannot join now because I think it was timed up to end of last month.
Yes.
But now we are in a new month, so it was not going to work for me. But thank God I've been able to join. Otherwise, how are you guys doing?
We are fine about.
Okay. So we lost you last time, Irma. You remember?
Yes, we can't get majority of the students. So how
Huh?
can we couldn't get the majority of the students except
Yes.
except Getacho. The other students
Yes.
get. That's why I'm not
Okay.
able to answer your.
Okay. But I can see today we have
Today also we have Getacho and Udase, I think.
Udase is there. Udase, how are you?
Udase now, Udase is not there.
Mm-hmm.
She's. I can call to him.
You're doing your presentation, right?
I am doing that, but the
Huh?
rest are not. I am doing, I think.
Yes. Yes.
Yeah.
So you needed to proceed, huh?
Mm.
I had received from you and from who was else? Malet
Meredith is not there.
is not there today.
Today is not there.
So can I give you a chance so that you do your presentation, then we see what to do next after that?
Okay.
All right.
No one is there. No. I'm trying to call them. The answer is
Yeah.
no. The phone is not answer.
Hmm.
They may be out of the town.
Okay. So once they are out of town, they cannot get connected.
Yeah. Most of them are there. The reason is that.
The network problem.
A network problem, or even they may not have power, electrical power.
Okay. So do you have slides for your presentation?
Yeah. I already delivered to you.
Huh?
Whom? Is mine?
Yes, Kirima,
Yes.
you have slides for your presentation so that you upload them so that we go through it.
Can I make again for the second time?
You had finished.
I have finished. Yes.
We lost you along the way, if I recall.
Okay.
We lost you along the way, if I recall. You are not finished. So can you just finish?
Yeah, I have already finished, and you are talking something like the market, many market, and the capital market, the regulation side. You are discuss on that topic. Finally, I already reported, and then you add something like money market and capital market. There's regulations. Even Kenyan capital market regulations. We let the minimum requirements. We discuss
Okay.
about that. Finally.
Yes. Yes. Okay. So meanwhile, as we wait for the others to join, I can. We have other areas that we have not. That I feel that we should address, other than those areas that they are supposed to address. For example, the market hypothesis and all that. Huh? We have the APT model. We looked at the CAPE model. We looked at the portfolio theory model, and we looked at the illustrations. And then we had also CAPEM, which we looked at the illustrations. And I think I also gave you an assignment to that effect. I think you'll be able to do it and ready to submit. You
When
have
do you
so
submit
far.
it?
Huh?
When do you submit?
Even today.
Huh? Even today?
When do you want to submit?
I think. Have you delivered the slide of the second this portion? The slide?
I have not.
Okay.
Have I not?
I don't have that, but I'm trying to do that. But the second question is difficult for me. A little bit difficult.
The second assignment.
Second assignment, assignment 2.
Okay,
I have
but
already finished the assignment 1.
uh,
Assignment 2 is a little bit different.
yeah, but we did that in class. We did illustration. Anyway, I will share that.
I need that. That's why it's clear.
I will share that.
Okay.
And then at the same time, I want us to go through the APT model, the arbitrage pricing model, and look at the process, the whole process of investment. Just allow me to share this as we wait for those others. In case they come in and they are ready to present, we'll give them room to go ahead. Because I had left this time for you guys to do your presentations. But now that they are not coming, I think we'll have to bear with that. So now I have to share this.
Okay.
All right.
ጌቹ
Yes.
ፕሬዘንት ማድረግ ትችላለህ እያለ ነው እኮ።
I'm ready. I'm not ready today.
Hello, doctor.
Yes.
I think Gecho is here. Getacho is here. With us?
Is he ready to present?
I think he's not.
He's not.
You can contact him. አናግረው ጌቾ አናግረው
Hello, doctor.
Hello.
Hello, doctor.
Yes. How are you? Hello. this is one of the theories that we need to understand, but it is still under development, because the difference between this theory and the one that we have been looking at, like the portfolio theory and the CAPM theory or the CAPM model, this one is a little bit different, because it encompasses, it incorporates all other aspects of the market as opposed to those others. So it was proposed by Stephen Ross in 1976. And in the CAPM, returns on individual assets are related to returns on the market as a whole. The key point behind APT is to the rational statement that the market is determined by a number of different factors. So according to APT, there are so many factors that may determine the return on an asset, and there are a number of factors like economic. There are those other the performance and all these the variables that we are going to look at that may actually affect the return on an asset. These factors can be fundamental factors or statistical. So we have fundamental factors and statistical factors, and we're going to look at both these factors. If these factors are essential, there is there to be no arbitrage opportunities. There must be restrictions on the investment process. Arbitrage is actually trying to accumulate returns from different sources, and then trying to come up with an average, all right, or appropriate profit, and then selecting one that is giving you the best profit out of many. If these factors are essential, there is there to be no arbitrage opportunity. There must be restrictions on the investment process. So you see, like now, like the controls are supposed to be put in the market so that we avoid a lot of this arbitrage. If you can imagine, like these people who buy shares and sell shares on behalf of others, they are called what? So these people are actually working on the arbitrage kind of anticipations or expectations, where they project that probably after some time that the share of a particular company, brokers, they are called brokers, all right, brokers. So a share of a particular company may be selling higher than it's selling now. So they buy now when it's selling low, and then sell when it's selling high, so that they make some profit. So that gain is actually the arbitrage we are talking about. So the arbitrage opportunities, we are talking about arbitrage opportunities, like there are those opportunities in the market which people can make use of, but it's only basically because of the availability of information. These people, before they decide to arbitrage, they must have some prior information about the company, the shares of that particular company, or the securities of that particular company, and then they take advantage of that, because many of the other peoples in the market do not have that information. And that's why I had a topic on the information asymmetry and the information hypothesis in the market, which was to come before we look at this. But you have to understand that information is power. Once you have the information, is you are powerful and you are able to take advantage of that, having that information to manipulate the market and make gains. All right. So these are some of the things that this theory is trying to postulate, and they actually make some of the players in the market gain profits or gains because of this arbitrage process that they are going through. Now, here arbitrage is understood as the earning of riskless profit by taking advantage of different pricing for the same assets on security. So you are taking advantage, like people buying goods from one location and coming to sell in another location because they are aware of the prices prevailing in the two different locations, then that is arbitrage. All right, that's arbitrage pricing because you are buying at a cheaper price, then selling at a higher price so that you can gain something, and then that is a process we call arbitrage. Arbitrage is widely applied as an investment tactic. You know, many people who deal in this kind of different types of investments actually rely on this arbitrage tactic. For example, those buying land, you know, in the land business, they would buy land at a cheaper price in anticipation that after probably some period, they will sell the land at a higher price. And of course, the difference is actually the gain they make. So this is actually things that are actually happening in the markets. And I'm sure it's also happening in your local markets there, where people buy things and then they are selling the same product, all right, at a higher price than what they bought it. But because of making some gain and what we are calling as arbitrage gain or profits. Now, APT states that the expected rate of return of security J is the linear function from the complex economic factors common to all securities and can be estimated using the given formula. According to Stephen Ross, he says that the expected return from a security or a project is dependent on several factors. And these factors are complex. They are complex and they can be estimated by this formula. So if you want to determine the return of a security, then you would apply this formula so that you come up with a proper estimate of the return of that particular security. So that's actually what Ross postulates. But I want to see the formula. This is the formula. Return of project or security J is equals to expected return of J plus beta, all right, of J1, J2, on until infinity, where expected return of stock J is represented by E, right, in bracket RJ. Then this is the expected return of security J if the influence of all factors is 0. So if the influence of all factors is 0, remember when we are looking at return on security, we used to have a bar, some bar somewhere at the top. All right. But in this case, now the bar represents where we did not consider those other factors. But here, it's represented by 0 because we are not considering those other factors. But when you consider those other factors, then you have to bring in this variable, which is now the change in the rate of return of security J influenced by economic variables or factors. So the factors are, they may be numerous. So they range from 1 up to n. N is indefinite. And then Bij is the coefficient beta, showing sensitivity of securities, J, rate of return upon the factor I. This influence could be both positive or negative. All right. So Bij, we saw Bi is the beta of project Ij, which is actually now the return on that project as risk. The risk of that project is actually now what you're looking at. So you can see these equations. Ij is the error of rounding off for the security J expected return. So this is just an area that is still under development because, you know, if you are to do an analysis as a manager, you may not consider all the variables in the market. There are so many variables, but you look at those ones that are core, that are likely to affect your area of operation. Okay, like for example, if you want to evaluate a project where you want to invest in a petroleum industry, then there are those factors which may affect the operations of a petroleum industry, and those factors that may not affect that industry. So you look at your area of concentration or your area of interest, and then now select those variables that are actually likely to affect your operation or your decision in terms of deciding whether to go for that project or not. So it's important to note that arbitrage in the APT is only applicable or approximate, it's an approximate relating diversified portfolios on assumption that the asset and systematic or specific risk are negligible compared with the factor risk. So this is only an approximate figure. All right, it's only an approximate figure. That's why we are saying this model is still under process. It's not fully usable, but it's good to know that some of these things are on the ground because they try to copy from CAPEM and also from the portfolio theory, and so that they come up with these other variables, which those other variables, the earlier variables that the portfolio and the CAPEM may have not really considered. There could be presumably be an infinitive number of factors, although the empirical research done by Ross together with the Ross identified 4 factors, economic variables, to which assets have even the same CAPEM are differently sensitive. So there are 4 variables that they actually came up with. We have inflation, we have industrial production, we have risk production, we have slope of the term structure in interest rates. Somebody is going to address this term structure of interest rates. And another person is going to address the derivatives and the markets, where we have the contracts that are happening in the market. All right, so this was to come after that, after we have been introduced to that. In practice, an investor can choose the micro factors, which seems important and related with the expected return of a particular asset. The examples of possible microeconomic factors which could be included in using APT model are GDP growth, interest rate, the exchange rate, a default spread on corporate bonds, etc. Now you realize that these are macroeconomic variables. There's a difference between macro and micro, you know. I hope you're able to notice the difference. When you talk about macro, these are the general economic variables. And micro are
the whole economic value.
Yes, and
Micro, small.
micro are different sectorial variables. Like it could be probably manufacturing, could be agricultural. So those are part and puzzle of the general economic variable. So if you are to mention some, you would see like you have the economic growth, you have the interest rate, the exchange rates. So these are some of the variables that are incorporated in the APT model. But you realize they are so wide and they capture a lot in terms of them themselves being the variable that have to be considered. So okay, including more factors in APT model seems logical. So because you know, the more factors you bring on board, the more accurate you are when it comes to returns that you expect in a certain investment. So this is probably the advantage that you could get with this, because you are considering a lot of variables that these other models may have ignored, and yet at the end of the day, they end up affecting our returns. Okay, so earlier on you saw we were using probabilities. These probabilities were actually estimates, and they could be representative of this variable that we are talking about when it comes to APT. So if you are using a probability, you know, a probability is just an estimate of what you expect to return, all right? But you may have considered some of these variables before arriving at a certain probability. But APT now looks into each of these variables and comes up with a measure that can represent riskiness in each of these variables that may affect the return of a particular investment. Now, the institutional investors and analysts closely watch microeconomic statistics, such as the money supply, inflation, interest rates, unemployment, changes in GDP, political events, and many others. All right, these are some of the issues, and we cannot run away from them. They actually affect the returns on a project that you may invest in. So there are variables to be considered, and that's what APT is advocating. Reason for this might be their belief that new information about the changes in this the changes in this in these macroeconomic indicators will influence future asset price movements. Yes, they are very likely to affect the price movements of the asset, because once the inflation rate increases, for example, the price is also affected in a way. Once the money supply, there's a shortage or high in, of course, money supply goes together with inflation. When there is high interest rates in the market, the pricing is also affected. When there's a lot of unemployment, the pricing is also affected. When there is political turmoil, for example, like when you have violence because of political results and all this, you know, these are things that affect actually the pricing of assets in the market. So there are factors that we need to consider according to APT, and we cannot ignore them. But the issue is, in a real practical situation, we don't really consider all this. But it would be at an advantage level if we considered all these variables, because they are likely to affect the pricing of asset in the market. And the pricing actually is a key determinant of our return.
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
Right? So it is important to note that not all investors or analysts are concerned with the same set of economic information, and they differently assess the importance of various microeconomic factors to the assets they have invested already or are going to invest in. So different players have different, just like I was saying, you look at the industry where you want to invest. So go for the variables that actually concern with that industry. All right? Ignore these others, because you cannot incorporate all of them. Though in a one way or the other they may affect, but the effect may be so minimal that we can ignore, or we can just provide. In terms of, like you saw our formula, we had an error term. Error term takes care of those other variables that we may not have considered when we are doing our analysis. So at the same time, the large number of the factors in the APT model would be impractical, because the models seldom are 100% accurate, and the asset prices are functions of both microeconomic factors and noise. All right. This actually explains what I'm trying to say. We cannot consider all those variables, but we can look at the key ones that are actually affecting the industry we're interested in. All right. So that we incorporate those ones, and then we have now the error term. You know, in our formula we had the error term. If I can take you there, this formula, the EJ error term, the error term, error of rounding off the security expected return. So we are assuming that we cannot consider all the variables because it's practically impossible. All right. So we just go for what we can manage. And what you can manage, the first preference is the industry we were interested in. Then now the others may come in, though there are microeconomic factors, and we have to consider those ones, particularly the microeconomic factors like interest. We have to factor in the inflation. We have to provide for that. But there are those other issues that are affecting the industry that we are interested in, then we go for it. All right, the noise is coming from mirror factors with a little influence with the result expected return of the asset. All right, so it is a minimal representation, which may not really make a big difference, whether it's put in the formula or not. The APT does not require identification of the market portfolio, but it does require the specification of the relevant macroeconomic factors. Much of the current empirical APT research are focused on identification of these factors and the determination of the factors beta. So we look at the factor. For example, if it's interest rate, the market interest rate. So what risk is it posing on the investment that we are likely to undergo or to undertake? All right, that's a big question that we need to ask ourselves. So this betas is what now we need to incorporate in our formula. Because if you recall, when you are looking at the CAPM, we are also factoring in the market risk. All right, the market risk, other than the risk of the individual asset. And then now there's also risk-free assets. So that's how we come up with CAPM. But in this case, we have a variety of factors that we have to consider, macroeconomic factors, and then not all, you see. So we have to evaluate the risk of each factor. What is the risk contribution of each factor in the return of this asset? Okay, so that's more of what we should be concerned with than just the variable. So at the end of the day, you will end up selecting those variables that have high effect, high risk effect on the project that we are anticipating to get to invest in. And then now the others which are minimal, we can ignore them, and therefore they will be taken care of the error term. Now the CAPM and APT are not really essentially different because they are developed for determining an expected rate of return based on one factor, which is market portfolio, according to CAPM, or a number of microeconomic factors according to APT. So this is the core difference between CAPM and APT. The capital asset pricing model and arbitrage pricing theory or model by Ross. So that is where the difference is. One is looking at it with the market portfolio, and the other one is looking at it as a number of macroeconomic factors. Both models predict both the return asset. The return on asset will result from factors, sensitivities, and this is of great importance to the investor. So both of them are looking at the return of an asset in relation to the sensitivity of the risk in the market, all right? And that is according to CAPM. And the other one is looking at it according to the risk from those other variables, macroeconomic variables. So don't be surprised when you're asked to to show the difference between CAPM and APT models in terms of their application. All right, because you can see this one is coming out clearly here. One is looking at it from the market portfolio, which is the market risk, and the other one is looking at it from the macroeconomic factors, risk from microeconomic factors. All right. And then it's important to note that. So this is APT, and you can see at the end of the day, we're looking at it and trying to differentiate it from CAPM. Now, CAPM and the portfolio theory, CAPM is a continuation. Portfolio theory is looking at an asset in isolation from the market. All right? Not CAPM really, but portfolio theory is looking at an asset in the isolation. That's how we came up with the issues like determination of an efficient portfolio using the efficient frontier curve. But CAPM came up with the capital market line, all right? And then there was the security market line, right? SML and the CML lines. So these models are actually developing one from the other, right? So APT is actually, it's not quite different from the CAPM, but you see now it's bringing on board other variables, which probably CAPM may have not really considered. Any question before we proceed to the other areas? Do you have any question?
No, we don't have.
Okay. Who has joined that is ready to present so that you can pick up from here?
Only Zamuru. The other is a host.
Huh?
Only Tamuru. There is no student. Other students.
The only Tamru.
Barihun
has gone.
Barihun also has gone. Yes.
Huh?
Barihun is host. Only to left.
The has gone.
Yes.
It's not. It's not. Is disappeared again.
He's disappeared again, I think.
Okay, now let's proceed for the remaining few minutes so that we leave tomorrow for the presentation. Now, stock analysis for investment decision making. This is also another area that is important for decision making in terms of investment appraisals. And as we know from the beginning, just like even from last semester when we had corporate finance, when you are evaluating a project, there are other variables that you have to look at other than just the return and risk of that particular project. Because, and fundamentally, I've normally said that if you have to invest, you don't invest in blues. You know, you invest in the market. And for you to invest in market, then you have to understand the market. So what are some of the factors that you need to consider other than the risk-return relationship that we have been looking at all along? So that's why it's important that we also understand some of these variables or factors that may affect our decision-making process other than just the risk-return relationship. All right?
Yes.
So, I want us today to look at the stock analysis for investment decision making. Now, the focus here is on the fundamental analysis of common stocks. So what are common stocks? What do you mean by common stocks, Girma?
Common stock is preferred stock, not no, other than stock like shares.
Shares. Which shares?
Common shares.
Common shares meaning what?
Meaning what? Share of the company.
Yes, shares of the company. So it means basically ordinary shares and
Ordinary shares.
current and preferred shares, isn't it?
Preferred shares.
Ordinary shares
Common
and,
shares. Ordinary shares.
Preferred shares. Ordinary shares and preferred shares.
Okay.
Are we together?
Yes.
Although technical analysis is used by many investors, fundamental analysis is far more prevalent.
Okay.
So, you know, we are used to, like as finance guys, we are used to technical analysis where we have to determine the expected returns, look at the risk of our project, all right? But there are also other factors which are so prevalent that we need to consider before making a final decision of where to invest and where not to invest, all right? So this is why we have also to understand this process. So we have, by performing fundamental analysis, investor focus, among other things, the future changes in GDP, changes in sales, other performance indicators for a number of industries, and in particular, future sales earnings for a number of firms. So, you know, benchmarking is very important in the market for a company survival in the market. So you need to benchmark, all right? And you need to forecast. Forecasting is also another area that is very important in the market if you are to keep appraised with the market and to survive in the market. You have to keep on forecasting.
Okay.
And that's why we have even a department of research and development, so that you can guess what is likely to happen probably 5 years from now or 3 years from now, all right? Products keep on changing. There are always new products coming in. The market is so competitive. And therefore, you have also to keep on doing your SWOT analysis to ensure that you are up to date with the market. And you are likely to survive in the market. Otherwise, you'll be thrown out of the market because of just mere competition and the mere changes in product. So these are now some of the variables that you may consider other than just the risk-return relationship that we have been looking at, where you have to determine the return of a particular project and you have to determine the risk of a particular project and then measure all that standard deviation and all this blah, blah, what you've been doing all along, all right? The main objective of this analysis for investor is to identify the attractiveness or potential investments. Yeah. Analysts and investors use two alternative approaches for fundamental analysis. Now, one thing that you have to note, Girma, for this particular class is there are basically two approaches of analysis.
Okay.
One, we have the, can you give me one? We have the technical approach, where you have now to collect statistical data. You know, it is even given there. The statistical data, do analysis, and then like what you did in our corporate finance, like you can do capital budgeting, determine NPV, isn't it? Determine
Okay.
internal rate of return, determine IP, all right? Determine the portfolio return, determine the investment, the return and the risk, all right? And then select on a particular project. That is the technical approach, all right? And then there is the fundamental approach. The fundamental approach. So under fundamental approach, we have now two alternative approaches. So these are now the sub approaches for fundamental analysis. Okay, so we have the technical analysis and we have the fundamental analysis. The fundamental analysis, now you can use two different approaches. We have the top-down approach, forecasting approach. We have the bottom-up forecasting approach. These are the two approaches that we can use. So what's the difference between the two? Okay. So I want us to go through each one of them.
Mm-hmm.
Now, using top-down forecasting approach, the investors are first involved in the making the analysis and forecast of the economy, then for industries, and finally for companies. So they start with the economy, the industry, and the companies. Which one is smaller?
Yes.
Among the three, the economy, the industry, and
industry,
the company.
and the company is small.
The company is small. So you start from the top,
Highest.
which is the economy, and then you come to the industry, and then you come to the company. Can you give me a basic example? Like assuming you are looking at, you want to evaluate a certain company operating in Ethiopia or in Addis. So you look at
monetary, like banks, just as industry.
So the economy would be.
The economy would be the money or the monetary policy.
The industry would be.
And this is a banking industry.
And the company would be
the share companies.
Huh?
Share companies.
Share is a
share companies. Yes.
Share
different banks, different industries have share companies.
So, like you select a bank, isn't it? A particular bank.
A particular bank.
If you are doing analysis, if you are to for example, to make a decision about investing for a certain. Can you give me an example of any bank in Addis?
Dashan Bank.
National.
Dashan Bank. Dashan or Awash.
Dashan.
Awash Bank.
Okay.
Yes.
So you look at the whole economy of Ethiopia.
Yeah.
That's the national economy. What are the interest rates? What are the inflation rates? What are the exchange rates? All right. And then now you come down, you look at the banking sector of Ethiopia. What is the banking sector of Ethiopia? How is it performing? And then come down now, after Ethiopia, now come down to specific company, which is now Gesha company, isn't it? Which is now the bank, Gesha Bank.
Yeah.
How is it performing? Right? You look at it in terms of in those levels, in those levels. Yeah. So because and that's what I'm saying. In all aspects, whether we are investing or sourcing funds, we must deal with the market. And the market is not within our confinement. It means going out of your confinement to look for information that's likely to affect your operation. So that is basically what you're talking about when you talk about the top-down forecasting approach. Then we have the bottom-up forecasting approach, the investor starts with the analysis and forecast for companies, then make analysis and forecast for industry and for the economy. So it's the reverse, right? You can start with the company, look at the company. That's what we call like SWOT analysis. Look at what you have. Then now go further, look at the industry. What is required for the companies or the industries or companies operating within that industry, all right? Then now look at the economy. What is expected of that sector in the economy, all right? So those are now some of the approaches that you can use. In practice, yes, go ahead.
Is this similar to deductive and inductive approach?
Yes, you can call it that way, deductive and inductive approach, or top-down and bottom-up approach.
Okay.
Yeah. So in practice, top-down approach prevail in analysis and forecasting because logically for forecasting of the company's performance, the changes in macroeconomic environment must be analyzed first. Otherwise, the inconsistent assumptions could be drawn.
Yes.
Yeah. So, you know, when we are looking at the risks that are faced by a company, we saw we had the two types of risks. We have the business risk and we had the market risk, isn't it?
Yes.
So when you talk about macroeconomic variables, those are actually the risks contributors, all right? So those are actually the market risk because we have no control over, and we cannot change it. We are just players in the market. We cannot change it. All right. So we have to try and see how we can ascribe to the prevailing conditions as given by the market. So that is what most companies do. So it's logical to start with the top down. You start with the macro, you look at the economy, then come to the industry, and then come to the company. And most companies, most industries are actually guided by policies made by the government, for example. Like agricultural, you'll find the government wants to promote agricultural and they come up with policies. So you find those are guidelines. You cannot change them. You have just to ascribe to them. So it's good that you understand those ones first so that you play according to those guidelines that have been provided. That's why it's more recommended than the bottom-up approach. Are you together?
Yes.
So the combination of two approaches is used by analysts too. For example, analysis and forecastings. Forecasts are made for economy using top-down approach, and then using bottom-up approach, continuing with the forecast for individual companies. So you can combine the two, all right? But at the end of the day, even whichever way you approach it, you'll always combine the two. Because in one way or the other, there are things that you have actually to observe as much as you make some of these conclusions and decisions. Despite the different approaches to the sequence of analysis, the content of it is based on the EIC analysis. So what is EIC analysis? All right. Girma, what is EIC analysis? EIC analysis is basically economy, industry, company analysis.
Okay.
Which approach is that?
Top-down approach.
Top-down approach. Very good. So that is now, we want to see, when you talk about economy, what are the basic items that, issues that you need to consider? When you talk about industry, what are these that you need to consider under industry?
Okay.
company. What are these that you need to consider?
Okay.
So the EIC analysis. So it includes one, economic, that is the macroeconomic analysis, describes the macroeconomic situation in the particular country, potential influence on the profitability of
stock.
Okay. So you have to look at the macroeconomic analysis. So when you talk about macroeconomic analysis, there are those issues. For example, you can give what? Look at this. The contents of macroeconomic analysis, the behavior of economics in the context of economic cycle. At what point of this cycle is the economy now? Is it at the growth stage, decline, recession stage? No, that's the questions you ask yourself. The fiscal policy of the economy or of the government, is it financially stable? Is it budget? Is there a budget deficit? Is there a budget debt? etc. The monetary policy. These are now the variables that you have to look for. The stability of national currency against the other foreign currency, the exchange rate, the ability of authorities, central bank to use the money market instruments on time, and many other variables. All right. So these are now the issues that go with the macroeconomic analysis, among others. Huh? The other economic factors include inflation, deflation. Is it inflation? The opposite is deflation. The level of unemployment. All right. What is the level of employment? The level of consumption. Investments into businesses. The possibilities to use different types of energy. Their prices, foreign trade and exchange rate of the foreign currency against national currency. That's the devaluation or revaluation. So these are some other factors that you may consider under the economic variables. Is there any question? Girma?
Yes, I don't have a question.
Okay. So when you go to industry analysis, we evaluate the situation in the particular industry, the economic sector and its potential influence on the profitability of stocks. Okay. So when we are talking about industry analysis, one way for the development of industry analysis is by focusing it into 4 important areas. All right. Now, this is now the industry analysis. Remember?
Yes.
About stock investment. Demand. Could this sector industry be described as growing, mature, or cyclical? How are this sector industry influenced by changes in GDP or interest rates? If the industry is cyclical, what is the key driver of its demand or of its demand? It's supposed to be of its demand. Or profit. Business capital expenditure or consumption cycle. How precisely the demand for capital expenditure is defined? Are the goods in this industry expensive, luxury goods, cheap, for day-to-day consumption? Those are now the question you ask yourself when you are doing an industry analysis. So that's just demand. Okay, there's also the pricing, because you can't price outside the industry. The industry has its own prevailing pricing methodology, so you have to comply with that. How concentrated is this industry? Okay. What are the barriers for entrance to this industry? Are they high? These are issues that may affect your pricing. If there is a barrier or restrictions to entry to this industry, then you are likely to price higher than if it's an open industry where anybody else can come in, isn't it? How powerful and demanding are the consumers in this industry? Is where in the market of industry's goods, the surplus, how strong is the fight for market share? So it should be where is the market for industry's goods, the surplus? Because, you know, you have also to understand the general market, you know, because where to sell. And, you know, that will also determine where to locate yourself. The areas where the goods may not be available, despite the fact that they are available in certain areas. So you may choose that, and that could be your pricing basis, so that you price according to the location where you are going to put up yourself. Is where in this industry a high competition in the international environment. All right. Then there are issues of costs. You have also to be keen about cost when it comes to industry analysis. How is the industry supplied with the implements of production? All right, because production is actually an essential aspect of cost. All right, are the tendencies of the prices for raw materials used in this industry substantially influencing the profit? Are the labor costs the main component? Is the question of qualification for the human resources in this industry? No, because human resources could be a core factor in cost determination for this industry, for this whatever you want to invest in. Because if it is a service industry, you'll find probably this could be a major aspect. All right. Now, the influence of the whole economics and financial markets, the industry, is this industry defensive or growing? How it could function in the period of economic recession. Now, this is actually now we are looking at the company analysis, the financial analysis of the individual companies from the shareholders' approach. So that's how you look at the company analysis. You look at it from the shareholders' approach.
Okay.
So is this industry defensive or growing? Is this industry influenced by interest rates or severe stocks? These are continuation. Okay. How the fluctuations in the currency exchange rate are influencing the sector? Are these fluctuations of currency exchange rate influencing the amount of profit received from abroad of the competitiveness of the sector? Is it Is there a possibility? Is it a possibility that political or regulation risk could influence the sector? All right. So these are sectorial analysis. It's a continuation of sectorial analysis. Now we have fundamental analysis. Now the best for the company's analysis is fundamental analysis, which are the publicly disclosed and audited financial statements of the company. Now, this now where we are coming in. And remember, we looked at the ratio analysis at the beginning of the course. Ratio analysis and interpretation of financial statements. So this is what we are calling the fundamental analysis. Now, the best for the company analysis is fundamental analysis, which are the publicly disclosed and audited financial statements. And we know these statements. We have the balance sheet, we have the profit and loss account, cash flow statement, and statement of profit distribution, or an appropriation account. Analysis could use the period not less than 3 years. So you can use 2 years or less than 3 years so that you can tell the analysis. Remember, if you recall what we did when you are looking at the ratio analysis. So ratio analysis is useful when converting raw financial statement information into a form that makes easy to compare firms of different sizes. This one was one of the advantages of ratio analysis, and I think we already have that. So the analysis includes the examination of the main financial ratios. We have profitability ratios, which measures the earning power of the firm. We had liquidity ratios, which measures the ability of the firm to pay its immediate liabilities. We have the debt ratio, which measures the firm's ability to pay the debt obligations over the time. We have the asset utilization ratios, which measure the firm's ability to use its assets efficiently, like things like the turnovers, debtors turnover, creditors turnover. We had the market value ratios are an additional group of ratios which reflect the market value of the stock and the firm. So we looked at this and we are able to compute some of the ratios, if you recall the beginning of our course. So this is where now the key relationship between ratio analysis and the investment analysis comes in, because we cannot do one outside the other. So as you can see, there are these ratios that help us make certain conclusions or certain decisions about the investment that we may want to make. So I'm sure this is a repetition of what we already did, and you can apply this to our previous discussion. And this is the fundamental analysis that you have to do if you have to do an investment. All right? If you have to understand the company, when you are doing analysis for the company, then these are the fundamental analysis that you have to do. You have to analyze the balance sheet, you have to analyze the cash flow statement, the statement, the appropriation account, and the profit and loss statement. And these are some of the ratios that you can compute, as we saw in our last presentation. Now, market value ratios provide an investor with the shortest way to understand how attractive the stock is. How attractive the stock is in the market, or how attractive the stock in the market is. Okay. But looking for long-term investment decisions, investor must analyze not only the current market results, but to assess the potential of the firm to generate earnings in the future. So we don't just look at the current, but we also have to look at the future expected earnings of the asset. And that's why we have to do like the expected returns, issues of expected risk of project probabilities and all that. So that's only using the other groups of financial ratios, investors can receive a full picture of the financial condition of the firm, and when you continue with the stock, and when to continue with the stock valuation. After calculating the ratios, the investor must compare the ratios of the firm with the ratios of the relevant benchmarks. So you also compute these ratios and can compare with the others in the industry. So other than doing the fundamental analysis, you're also doing the industry analysis alongside this ratio analysis. The selection of the appropriate benchmark is a difficult decision. For this reason, firms are frequently benchmarked against other firms with similar size and in the same home country or industry. All right, so it's always good to benchmark yourself against your peers in the same industry because you kind of operate within the same conditions, the same regulations, environment, and all those other factors. However, such comparisons do not always reveal whether the company is buy worth because the whole size category, country, or industry may underperform. When using these ratios for analysis of the firm, investors compare them also with industry averages. So you also compare with industry averages, like we did last time when we were looking at the ratios. We could compare the industry average, like for example, the liquidity ratio, we know the appropriate ratio according to the generally acceptable standards, 2:1, and all that. Okay, any questions?
No, I don't have question.
Jeremiah, you're saying you don't have a question?
Yeah, I don't have question, but I'm waiting
If
the
I
slide
ask
of
a
this.
question, if I ask a question from this area, I will score 20 out of 20. Is that what you're saying?
Yes.
That's good. So your colleagues are not there.
Yeah.
I think
We'll have class tomorrow.
yes, and then tell them to come and present their bit
Yes, okay.
so
We'll try.
that we can look at now the portfolio performance measures after their presentation.
Okay. Could you send the slide of the others?
Yeah, I will send you the slides for the previous classes.
Yeah.
All right.
Okay.
So that
Alright.
and then now you also need to send me your assignment too.
Okay. If I finished, I'll send you.
Okay. Okay. Good night.
Okay. See you.
And,
Okay. Good night.
thanks for turning up.
Thank you.
Mention to others that we want to finish up because I saw the timetable is out. You are supposed to be doing your exams in when?
I think
in 2 weeks time or 1 week time?
I think it is we have additional day, 60. October 60. It seems to be October 60. After 10 days. So the next 2 class, we may have 2 class or 3 class. We have left.
No, if all of you come to present tomorrow,
Okay.
then we may have just another
class.
weekend, another week, just to finish.
ልዩነት መፍጠር ዓላማችን ነው። ዓለም አቀፍ ተወዳዳሪ መሆን አለባችሁ። የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ጥራትና ደረጃውን የጠበቀ ስልጠና በመስጠት ብቁ ዜጋ እያፈራን ነው። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆቴልና ቱሪዝም ሙያዎች አሰልጥነን ተወዳዳሪ እናደርጎታለን። ኮሌጃችን ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ICM ጋር በመተባበር ዓለም አቀፍ ዕውቅና ያለው ስልጠና እየሰጠ ይገኛል። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ የምንሰጣቸው ስልጠና ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና አለው። አድራሻ ከጎላጉል ታወር 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ህልሞን እውን ያደርጋል።